Good afternoon. Asian markets tumbled after a volatile session overnight on Wall Street. Japan's Nikkei closed 1.6% lower, and the Hang Seng Index in Hong Kong declined as much as 1.6% as well. Mainland Chinese stocks were lower. European stocks were higher as investors in the region appeared to shrug off volatility in global markets at the start of the week and concerns over Ukraine. Meanwhile, the Fed starts its two-day meeting today, at which it will decide on the next step for U.S. monetary policy. The committee is not expected to begin hiking rates just yet, but the central bank is expected to maintain a path towards tighter policy this year as it fights the highest inflation in decades. To talk to us about the latest developments, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. I mean, given what's happening globally and also the potential risks out there, how is our local markets doing right now?
Good day to you and to the viewers. After slumping yesterday, we are trying our best to try to recoup, but I think it's a long way to go because we've done almost 3.5%. We just went up almost 1%, so we are unable to recoup some of the losses that we've seen yesterday. But the JSE's performance is in line with what we're seeing also in Europe, and I think the markets are strongly feeling that this whole situation was oversold because remember, markets are becoming very anxious about the rapidness of the U.S. Federal Reserve. You know that how will they start increasing interest rates, and as a result, we see volatility playing into the market. But truth be told, Nastasia, we all know this whole issue was well telegraphed that the U.S. will start increasing interest rates at least as from March this year. So I don't think the market was supposed to have reacted the way they did yesterday. Yes, we still have issues when it comes to Ukraine, but these issues, they still have to see whether will Russia definitely attack Ukraine. And chances are, at this day and age, I don't think there's any country that can afford to have an unnecessary war.
The other news item that dominated, I suppose, markets yesterday was the announcement by Sabia Stillwater that they're going to be ending their $1 billion Brazil mine deal. The share price yesterday fell 8%, and it was quite interesting when you looked at analysts' viewpoints. I mean, do you see this as a missed opportunity in the short run, given that they have these plans to go into a different space? Or is it, I suppose, good for shareholders in the short to medium term? Because from a dividend point of view, you're not having $1 billion sort of leaving company coffers.
I think it's more of a missed opportunity. Remember, the issue that they've been diversifying, the issue that they were getting involved into critical minerals, I mean, that excited and was baked into the asset price that the guys will be diversifying and get or minerals that gets to be used to make batteries, and they get to be involved when it comes to electric vehicles. But yes, as much as it was baked into the asset price, if we realize that it's not going to be happening, it only makes sense to see the share price going down. And I think as the executive of Sibanye, that was the right decision for them to make that, guys. There's some significant material conditions here. We just have to move away from the deal. We just hope that going forward, they're not going to become too desperate and try to buy into anything that comes their way in order to make up from that missed opportunity, as you said.
Right. Let's take things stateside and look at U.S. earnings season. I mean, what's your take on it so far?
So far, not too bad. Unfortunately, it gets to be overshadowed by this whole issue about the Ukraine issue and the interest rate that is looming in the U.S. and the inflation being the key thing. But markets or companies have managed to deliver just above 20.5% of what is expected when it comes to their earnings. But we need to bear in mind that those results are backward looking, and we know that we are buying stocks going forward. Now, as a result, we want to see their focus going forward. Are those forecasts justifying these high prices or high valuations that we see in the current stocks prices?
The one thing that I found quite interesting when looking at some of the earnings numbers is that you sort of didn't get a full picture in terms of earnings guidance this time around. And I'm wondering whether it's due to the uncertainty that's out there from a business and an economy point of view, especially when you interest rates, supply disruptions, etc.
It's difficult to give a proper guidance, and we know that we've been having issues with Omicron, issues with possible variant that might come out when it comes to COVID-19. But yes, inflation continues to be a big issue, and inflation not necessarily driven by oil prices, but inflation driven mainly by supply chain bottlenecks, because everybody's complaining when it comes to supply chain bottlenecks, and bearing in mind that we might still have more of those, especially when it comes to this terrible weather that we get now and then, because you get terrible weather, then you close the ports ports, we close the factories, then that's another bottleneck.
I mentioned in my intro that the FOMC meeting starts today, and tomorrow all focus is going to be on Jerome Powell's press conference. What will you be listening out for if you're going to be tuning in live, or if you're going to be grabbing your Thursday morning newspaper?
To see whether are they going to start shrinking the huge balance sheet that they have, and also to see if we can gather any sense whether the guys will increase interest rates at least 3 or 4 or 5 times this year. I think that will be critical for us. And as we are saying, interest rates are not good for equities, but the rapidness is a problem. So if we see that probably they will start increasing gradually, then probably I think the equity should be able to stomach that. So the question is how rapid the guys will be increasing interest rates.
Will you be looking out for the similar themes when our SAB MPC announcement comes out on Thursday? I mean, what are other issues you're going to be focusing on from a South African point of view as it relates to our MPC?
Already we've seen locally that inflation is already an issue at 5.9%. We've seen that our Reserve Bank started increasing interest rates in November, and definitely the guys, they don't want to be behind the curve because they need to maintain that interest rate differential between the rand and the US dollar so that we continue to benefit from that. And yes, we know that we've got administrative prices which are out of their control, and definitely we expect them to increase interest rate. The question here is, do we start expecting an increase in interest rate in every meeting? So I think one also has to see the guidance from that is this whole thing going to be continued by data? They will assess data as it comes through to make that decision at a particular point in time. But definitely we expect them to start moving as soon as Thursday.
Are equities still the place to be if you're looking for opportunity right now?
Definitely in the long run they are, but bearing in mind that you don't have to have a fixation and get married to a particular stock. You don't have not to be able to change your mindset that things have changed the way you are looking at. And yes, you will always get to a point where you can start buying into the dips. People are just worried about what we've seen yesterday, but truth be told, if this period is a period where we start seeing interest rates going up, then definitely the likes of our banks should continue to benefit, because for a long time the guys have been at 0 or negative interest rates or lower interest rates. So they should start generating at least some decent income when it comes to their net or when it comes to their interest income. So those are the kind of sectors that they start looking at.
Are you buying the dip right now?
Especially when it comes to the banks, definitely we are a player.
Is this local banks or US banks?
Fortunately, it's local banks because we understand them much better.
All right. And in terms of, tech shares, in terms of from a U.S. point of view, is that still the place to be, or are you nervous given the environment we're going to be going into in a month's time? Would you still hold U.S. tech shares?
Not at all, because remember when interest rate starts going up, what it does when it comes to tech shares, we buy them and their prices, it's all based on their future earnings. So in an environment where interest rates go up, unfortunately, it gets to start eating into those earnings going forward. Yes, you can still get a 10% increase on them, but you compare that with other asset classes, which you should be able to do much better. And I think the guys have made their money out of that. Just look what is happening to what we call our local tech shares, whether it's your next pass or process. So we're not saying they're going to drop, but the returns that we'll be getting out of them compared to other sectors, I think will be better off on the other sectors.
Makwe, thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers.